The year 2014 marked the beginning of Bitcoin's ascent. The cryptocurrency surged in value, surpassing all expectations. This rise coincided with a period of extraordinary monetary and fiscal policies. Central banks were injecting liquidity into the system. Governments were running large deficits. This created an environment of easy money. Asset prices across the board inflated. This included Bitcoin. The exuberance surrounding Bitcoin was palpable. Many saw it as a revolutionary technology. They believed it would disrupt traditional finance. However, warning signs began to emerge. The speculative nature of Bitcoin became increasingly apparent. Scams and illicit activities plagued the crypto world. These were red flags that many chose to ignore. The year 2022 marked a turning point. The 30-year Treasury yield broke its long-term trend. This signaled the end of an era. The bubble built on excessive liquidity and speculation began to deflate. Many assets, including Bitcoin, experienced significant corrections. This was a stark reminder that what goes up can also come down. Bitcoin is often touted as a decentralized alternative to fiat currency. It is said to be free from government control and manipulation. While this narrative is appealing, it is important to approach it with a critical eye. Bitcoin's value is not derived from any underlying asset or cash flow. Its price is driven purely by supply and demand. This makes Bitcoin highly susceptible to speculation and market sentiment. When investors are bullish, the price of Bitcoin can skyrocket. However, when sentiment turns negative, the price can plummet just as quickly. This volatility makes Bitcoin a risky investment, especially for those seeking long-term value preservation. The lack of regulation in the crypto space further exacerbates these risks. Scammers and fraudsters are drawn to this environment. They exploit the lack of oversight to prey on unsuspecting investors. This lack of regulation also makes it difficult to track and recover stolen funds, leaving victims with little recourse. In contrast to Bitcoin, gold has a long and established history as a store of value. For centuries, gold has been recognized as a tangible asset with intrinsic worth. Its value is not tied to any particular currency or government. This makes it a safe haven asset in times of economic uncertainty. When investors lose confidence in fiat currencies or financial markets, they often turn to gold. This flight to safety drives up the demand for gold, pushing up its price. Gold's performance in recent years is a testament to its enduring value. As the bubble in financial markets began to deflate, gold held its ground. In fact, its price surged past the $3,000 mark, reaching new all-time highs. This resilience in the face of market turmoil underscores gold's role as a true store of value and a hedge against inflation. The cryptocurrency market, while often touted as decentralized, is not immune to manipulation. The concentration of wealth in a small number of Bitcoin wallets raises concerns. A select few individuals or entities hold a disproportionate amount of power. This concentrated ownership creates an environment ripe for market manipulation. These whales, as they are often called, can influence the price of Bitcoin with their trades. This manipulation can harm smaller investors who are not privy to the same information or trading strategies. The lack of transparency in the crypto market makes it difficult to detect and prevent such manipulation. The risks associated with Bitcoin and the broader cryptocurrency market are real and significant. While these digital assets may hold some speculative appeal, they lack the stability and intrinsic value of gold. Investors seeking to preserve their wealth in these uncertain times would be wise to consider the lessons of history and turn to the time-tested safe haven of gold.